Hello, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute. Thanksgiving's over. We're into December, the holiday season. Parties are starting to happen. You're decorating your house, your tree. It's getting to be a busy time. We're going to actually deviate a little bit from our usual program. I want to dedicate today's program specifically to reverse mortgages. I think there's a lot of misunderstanding about the product, so I want to go ahead and add my 2 cents as to what it's all about. So on this first slide, I want to show you basically the idea that the reverse mortgage product can provide a senior homeowner a tremendous amount of very good benefits, but yet it is a product that I've observed to be feared by a lot of senior homeowners and very much misunderstood. So we're going to dedicate again today's program simply on the reverse mortgage product. So in that respect, there's been a lot of information out there online about the product for years. I'm going to add my own contributions to all that information. Some of you may have already seen. One thing I want to point out to you is the reverse mortgage product, the one that is used primarily in the country, it's called a HECM. That stands for Home Equity Conversion Mortgage. And what's interesting about that is a lot of folks don't even know up to today that HECM is actually an FHA loan product. And because of that, FHA, of course, being a Federal Housing Administration, that's going to imply, and that means that this is a product that's actually designed very well for the protection of the homeowner. And the first thing I want to point out about the HECM reverse mortgage, because again, that's the type of mortgage we're going to focus on. There are other reverse mortgage products, which I'll get to later. First and foremost, understand that a HECM reverse mortgage, frankly, any reverse mortgage, it's a mortgage, just like a mortgage, any other mortgage. Just like the mortgage, for example, when you bought your home, you may have gotten a mortgage to buy the home. So this reverse mortgage type product is the same. And what's so funny about that is oftentimes people, I still hear it today, think that if you get a reverse mortgage, that means the bank owns your home. Well, that's simply not true. When you got that mortgage initially, that traditional, what we call forward mortgage, you got a mortgage that was secured by your home. Did that mean that the bank owned your home? You probably didn't think that. Well, you shouldn't think that with a reverse mortgage either. A reverse mortgage, just like a traditional forward mortgage, is going to be secured by your home. Your home is going to be collateral for that loan. But that still means you own the home. The bank, the lender does not. Now, if you don't perform certain obligations, like make the payments on time and so forth, you could trigger a default, which could start the foreclosure process, the outcome of which, of course, could be the bank could end up with your home. But again, that's not the same as the bank owning your home at the point you get the reverse mortgage. So that is the mode of thinking you just want to eliminate and get it out of your head, because it just doesn't work that way. The key point to understand about a reverse mortgage is it provides you a tremendous opportunity for benefits as a senior homeowner, and it provides you a lot of flexibility in terms of how it's paid back. So that's the important thing to understand. Now, it allows senior homeowners who are 62 years old plus, 62 years old or older, to access the equity in your home, or it also allows you, if you're 62 plus or older, to purchase a home with the reverse mortgage. So again, an important point to understand, a reverse mortgage can be used not only if you're currently a homeowner, but also if you're looking to buy a home, you meet the age requirement, you can use a reverse mortgage to purchase the home. So with that, I want to go ahead and go to the next slide. And again, there's that key point. Monthly mortgage payments are not required. Key point, required. I'll come back to that a little bit later to expand on what that means. So in the next slide here, we're going to get into who is eligible. I just mentioned for HECM reverse mortgage, you have to be at least 62 plus years old. Now, when I say you have to, I mean at least one borrower. Very often today, borrowers are a couple, usually married. So in that case, we have to have at least one borrower that's 62 years old or older. What does that mean as to the other partner, the spouse, the other borrower? They don't have to be 62 years old or older. They can be younger. But the important point to understand is that if one of the borrowers in a two borrower situation, again, typically a married couple, the amount of loan that you can get is going to be dependent on the age of the youngest borrower. So now you can have a borrower who's over 62, sometimes well over 62, and then a borrower who's under 62, maybe several years under 62. The two of them together can still get that reverse mortgage. They'll both be on the loan, but because the loan amount is based on the age of the younger borrower, it's going to affect how much that you can get for that loan. So just keep that in mind as to the eligibility for a reverse mortgage. The other thing I would want to point out is you have to own your home, obviously. It has to be your primary residence. They have to have at least 50% equity. I would say preferably more. And again, I'll come back to that a little bit later as to why that's the case. So a lot of times folks think they can get a reverse mortgage up to 70, 80, 90% of their value. That's just not true. That's really not how they work. Property types can include single-family residence, multifamilies, and condos. And there is a financial assessment that is going to be done as part of getting the loan. But it's more about residual income analysis. Your FICO score doesn't really matter. There's no debt-to-income ratio requirement, and there's no reserves required. So understand that the point of the financial assessment is to establish eligibility, not based on the dreaded, minimum credit score or debt to income ratio. It's more about residual income. So that's a key point to understand when it comes to a HECM reverse mortgage. Now, the next thing to understand is how does a reverse mortgage help you achieve your top goals in retirement? And I've got an interesting list here that I want to show you because I think it'll be a little bit surprising to you in terms of why do people get a reverse mortgage, at least those folks who own a home currently, and they're considering a reverse mortgage as an opportunity to meet their retirement goals. Well, of course, the biggest goal, believe it or not, and it's probably not that surprising, is have enough money to live on in your lifetime, to last your lifetime. As you can see, there's 71% of reverse mortgage borrowers. That's their primary goal. Have enough money to last your lifetime. Not far behind that, remain financially independent. And those kind of go together, as you probably can see. The next one is stay and live in your home. How many of you know your own parents, know other senior homeowners? If you talk to them, what they want more than anything is they want to stay in their home, they want to live in their home and live independently. And as you go through this list, you're going to see other goals that reverse mortgage or senior homeowners try to achieve. Have enough money for medical expenses, emergency funds, interest and or hobbies. A lot of times folks have interests or hobbies. Maybe they even want to start a small business. They need to have some seed money. A reverse mortgage can help them tap into their equity to do that. And when you go through the list, spend time with family and friends. What's kind of surprising is how low on this list is leaving money for their heirs. That is not a primary goal for most senior homeowners in getting reverse mortgage. Now, that sometimes doesn't align with their heirs and what their heirs want, which of course can be a little bit tricky in terms of talking about a reverse mortgage with a senior homeowner. I've had a good amount of experience with that. And then sometimes it can be a little bit tricky. And of course, very few senior homeowners are interested in spending most or all of the money during their lifetime. So that's important to understand about why people get reverse mortgages, and understanding that in reality, in most cases, what they're really focusing on is having enough money for the rest of their life, being able to be financially independent and being allowed to stay in their home. So on the next slide, I want to get into what I think is really a misunderstood aspect of a reverse mortgage. Reverse mortgages, yes, everyone thinks, oh, it's a mortgage where you don't have to make payments. That's true. And again, the senior homeowner's biggest fear is that the growth of the reverse mortgage balance due to not making payments. But ultimately, borrowers do get more control. Reverse mortgages provide more flexibility. So what do I mean by that? Well, think of it this way. Flexible monthly payment can mean multiple things. You can pay interest only. You can do pick-a-pay. What do I mean by pick-a-pay? Well, you can decide how much to pay and when, and in the amount you want. You could do it every month. You could do it every quarter. You could do it a couple of times a year. So again, you have these options. Pick-to-pay is one of those options. Another option is to pay to create liquidity. A lot of times when people get a reverse mortgage, they're going to get it set up as a line of credit, which I'm going to touch on a little bit more later. But if you do that and you borrowed some money on that line of credit, if you decide to pay back against that line of credit, you're going to create more liquidity because that line of credit is going to grow over time. And of course, the other option that you have is you can go ahead and get a lump sum. You're going to go ahead and not make a payment at all. And of course, that if you do that, you are going to see that loan balance go up from year to year. So the point here is, you can see you've got multiple options in terms of controlling how much that loan balance grows over time. You don't have to just sit back and be forced to not make a payment and watch that loan amount grow over, every month up and up and up. That's really up to you. Now, understand, obviously, in some cases, you may be financially strapped in terms of monthly income or liquid assets to be able to comfortably make payments. Obviously, that's a primary focus on this reverse mortgage too, is to help those kind of senior homeowners. But if you have some monthly income, if you have some liquid assets, you have flexibility in how you make those monthly payments. That's an important point to know. Now, another thing to understand is that I think reverse mortgage, which is not well understood, gives you flexibility of access. You can access the funds from a reverse mortgage in a multitude of ways. So how do you use that home equity? Well, the most popular option, I just mentioned it, is the line of credit. Now, what does line of credit with growth mean? Well, when you get part of your funds or maybe all of your reverse mortgage funds set up as a line of credit, an important feature that is not well understood is that when you set it up that way and you've not maybe used very much of it at all initially, maybe it's got almost a zero balance, that line of credit will grow over time, because the line of credit for the unpaid, unused portion of the line of credit, it grows over time. Think about it. If you get a traditional home equity line of credit, it doesn't work that way. When you get a line of credit for $100,000, that's all you're going to have a credit limit for is $100,000. An important feature with a reverse mortgage line of credit is for the unused portion, it grows over time. So if you're setting it up to use later as a rainy day fund or for future expenses and so forth, understand that as you're waiting and not using it, it's growing. So that's going to give you access to more cash later. Another way that you can access the cash is to get monthly disbursements. This can be either term or what we call tenure. Term simply means you could set up a monthly payment to receive each month of maybe 5 years, 10 years, 15 years, 20 years. Or you can set up a lifetime monthly payment. We call that tenure payment. So you get a monthly check for your lifetime. Another option, of course, is a lump sum. This is usually not recommended to be the best option to use, only because, particularly if you're going to go lump sum and take the maximum amount at closing, you're going to limit how much you're going to be able to access. Because with a lump sum distribution, if you take the max, which is 60% of the available funds during the first 12 months, you lose the ability to get the remaining portion. So a lump sum is usually not the best option if you're trying to max out all of it as a lump sum. You're going to get less total proceeds or access to your equity with that option. The fourth way to do this is you're going to have a combination of options where you could set up at closing of the reverse mortgage a line of credit with some growth for the unused balance of the line of credit. You can set up a monthly payment for a term, say 10 years, and you can get a little bit of lump sum at closing too. So the point is you have flexibility of access. Again, more control. You can set it up with any one of these ways to access or all of them, which, obviously we can help you design that. That's going to be the best way to meet your needs. So the other thing I want to point out is a reverse mortgage gives you lots of ways to leverage the equity in your home. And this gets to the point of how you're going to use the proceeds of a reverse mortgage. So we're going to show you a list right here of the different ways you can use a reverse mortgage. One of the obvious things you can do to use a reverse mortgage is make investments. Sometimes folks think that you're going to use a reverse mortgage because you're short on cash, you're barely getting by, you need to access equity just to meet basic living expenses. And yes, of course, that is part of the focus of this product, but it's not the only one. Quite often, a senior homeowner may be financially quite secure, but they have a free and clear home. And they realize that they might be able to take that equity and make some pretty significant investments that might generate a very good return and make it very worthwhile to use the reverse mortgage program as a tool to make investments. Or consider the next one that you're seeing there. A lot of folks think that they own a home free and clear. When they pass away, it's maybe in their will, their living trust, that it's going to go to their heirs, to their family, who are going to inherit that equity. Well, consider this. What about taking a reverse mortgage while you're still alive and gifting some of that equity access to your heirs, to your family, while you're still living, so you can enjoy observing, watching the benefit you're going to provide to your family? I mean, isn't that a more terrific way in some respects to take advantage of this product, get some of that cash equity out of your home, even if you don't need it personally, and basically give a down payment or advance toward that inheritance that your family, your heirs are eventually going to get, and enjoy the process of them using that, hopefully in a beneficial way, to enrich their lives while you're still alive and can see that happen. I think that's a very interesting and underutilized option for using a reverse mortgage that we always try to point out to folks when we're talking to them about it. So another thing to look at in terms of reverse mortgage, obviously retrofit your home, particularly if you have health issues. Maybe you've got to make some changes to your home to account for the health issues you are dealing with. A reverse mortgage can be a great product in that regard. Another thing to look at is preserving your assets. Now, this is an interesting one, and it's a little more complicated, but here's what I'll leave you with. Again, some senior homeowners may own a home that's free and clear. They may be very financially secure. They may have a good monthly income from retirement, Social Security, or combination of those things. They may have a substantial amount of money in retirement accounts and liquid reserves. In fact, maybe they have an IRA account set up and they're taking monthly distributions for income to live on and enjoy their senior years. Well, there's a concept regarding preserving your assets where you want to be a little bit careful of what they call, or financial planners would call, sequence of risk returns. So a reverse mortgage can be a great tool to use where maybe you're drawing money from your IRA account and you have a free and clear home. You might consider getting that reverse mortgage, set up a line of credit, and then as you're drawing against your IRA for living expenses month to month, what if there's a 20% correction in the market? That's obviously going to depress the value of your IRA account. Well, when that happens, the risk sequence of risk return strategy says stop the draws on your IRA account. Instead, replace the draws from your line of credit in your reverse mortgage until such time your IRA account has recovered from the market dip. That way, it will preserve your assets and allow them to last for a longer period of time. It's a great strategy, a little complicated. If you're a homeowner in that situation or you know someone who is, this is a great concept that we can provide some material to your financial planner so you can talk to them and strategize how to use a reverse mortgage as a strategic tool for this kind of approach. Another thing to look at in terms of use of a reverse mortgage is financing home care. Again, kind of similar to retrofitting your home. If you've got some health issues, you may be at a point where you're going to need home care. But again, remember, you want to stay in your home. You don't want to vacate your home. In fact, if you vacate your home for over 12 months, you got to pay off the reverse mortgage. So a reverse mortgage can be a way to finance home care so you can stay where you would be happiest, which of course is in your home. Another thing to look at in terms of reverse mortgage is consolidating debt. Obviously, we do run into that. Actually, these days, more often than you would think, where homeowners have lots of equity, limited income, limited liquid assets. They've run up some debt. Obviously, a reverse mortgage can be a great tool to help them with that scenario. And then lastly, another idea, how about this? Build an ADU for additional income. You could rent it out. Again, a way to generate income if you're trying to get more income to live on more comfortably in your senior years. Or another option is you build that ADU and maybe you have that 35-year-old in your spare bedroom, you'd rather get a little more space and build that ADU so your son or daughter can have a little bit more privacy and be still living on your property, but in a separate unit there, so that that way you've got a little bit more separation, a little bit more privacy. So obviously, a reverse mortgage in terms of leveraging your assets can be a very, very valuable tool. So now what we're going to do on this next slide is we're going to talk about a little bit the reverse mortgage loan product types. Pretty simple. There's a fixed rate option or an adjustable option. Now with a fixed rate option, obviously very straightforward. It's going to be a fixed rate, but generally speaking, if you go with a fixed rate, you're going to get a lesser amount of loan proceeds. That's just the function of the program. And the fixed rate option will provide or feature a higher interest rate than an adjustable rate option is going to be. So keep that in mind. A fixed rate, which a lot of people initially think is the best way to go. Once we explain the details about that, what they find is that's not necessarily the best way to go. And more often than not, they're going to look at going the adjustable route. Now, the adjustable loan that is used, the one that's used primarily, it's called, this gets a little technical, the monthly CMT Cap 5. What that means is it's a monthly arm. It's tied to the constant maturity Treasury index, and Cap 5 means the life cap. So again, the index is the 1-year Treasury constant maturity. Right now, that value is about 4.35%. Now, there's going to be a margin added to that, and typically that margin is going to be somewhere in the 2.25 to 2.75 range. Where the margin is set at is going to determine what your average interest rate is going to be, and it can affect the loan amount available that you can get. And again, it does have this life cap at 5%. Oh, by the way, yes, the adjustable rate loan will have a lower initial rate than the fixed rate option. Now, folks, though, are going to be concerned about what if rates go up. Well, this one has a very reasonable cap, life cap of 5% over the start rate. So with the current rates for the adjustables, which are in the mid 6s, you're going to be capped out no worse than around 11 plus. Now that sounds high, obviously, but historically, remember, mortgage rates got to 18%. So this product is designed to protect the homeowner in a rising rate situation. But more importantly, the adjustable gives you the opportunity, if rates are going to fall or we get into a falling rate trend, this gives you the benefit of being able to take advantage of that. And of course, as many of you know, there's a lot of talk still that mortgage rates are going to fall over the next couple of years. So getting the adjustable reverse mortgage type is probably your better option. Plus, it'll get you a higher loan amount in most cases. So we do find that, believe it or not, a majority of reverse mortgage borrowers do end up getting the adjustable rate over the fixed rate. So keep that in mind. So the next thing I want to talk about is how is the loan amount calculated? A lot of folks think, okay, I want to get a reverse mortgage. Is it like a traditional mortgage where you can get a loan depending on your credit score and your property type, and other factors that you can get up to 90% of your value or 80% of your value or 75 or 70 or 60? No, with a reverse mortgage, there is no LTV or what we call loan to value grid as there is with a reverse mortgage. It's not that simple. Instead, understand, it's a simple concept. The available loan amount is going to be based on a combination of your property value and the age of the youngest borrower to arrive at what is called a principal limit. Now, think of principal limit as your gross loan amount. Now, the remaining principal limit is after you deduct mandatory obligations. So what the heck are mandatory obligations? Well, that's going to include certain things like if you have an existing mortgage that needs to be paid off, that's a mandatory obligation. If you have upcoming property tax installment, that's a mandatory obligation. You have an upcoming homeowners insurance renewal. Again, that's a mandatory obligation. And then, of course, closing costs also will be deducted from your principal limit to arrive at the remaining principal limit. Think of that remaining principal limit as your net loan amount. That's the amount that you have access to use however you want based on the different options that we showed you earlier on the earlier slide. So again, understand that reverse mortgage loan amount is not as simple as just saying, okay, I can get 80% of my loan or 85 or 70%. It doesn't work that way. Now, the other concept to understand is the older the borrower, the higher the loan amount is available. And it's a combination of that and your property value. But in a best case situation, that can still mean a relatively small amount that surprises most people. If you have two borrowers, the younger borrower, particularly if you're under 62, will reduce the available loan amount, and sometimes substantially. Why would that be? It's because understand that the idea here is the amount you're going to get is being set up based on actuarial tables for life expectancy. So if you're a married couple and one of you are 78 and the other one is 61, what they want to do is design the loan so that as it grows over time, if you're not making payments, again, you can if you want. It's not required to not make payments, but if you don't, the loan is designed to ensure that over that many years to life expectancy, the loan won't grow higher than your property value. So because of having a married couple where one is substantially younger than the other, it will affect your loan amount. On the downside, it's going to be lower to account for the fact that one of the borrowers is much younger than the other. Now, this fixes a problem that did exist not too many years ago, where if you had a married couple and one was over the 62 eligibility age, but the other was not, the younger spouse had to basically be taken off title, not be on the loan, and so that the older borrower was holding title themselves and holding obligation on the loan themselves. And then when they passed away, that causes a default on the reverse mortgage. The loan has to be paid off, and the younger spouse, surviving spouse, essentially would in most cases be forced out of their home because the loan amount wasn't set up based on their age, but based on the older spouse. So that problem was fixed with this now approach where you can have a younger borrower when there's at least two that's under 62, but the loan amount's going to be reduced so it doesn't grow too fast based on the life expectancy of the younger borrower. So keep that in mind. Based on that, best case situation, if you're really up there in age, in fact, I did one the other day where the borrower was 90 years old. And if their home was free and clear, they were going to get just about 60% of their home value as available funds to access. Again, that's about the max you're going to see. If you're younger, and particularly if you're a younger spouse and a married couple and you're under 62, that loan amount can come down quite a bit, sometimes as low as about 25% or less of your value. That can sometimes be disappointing to a borrower or to the borrowers, but again, it's actually designed with the thought in mind of protecting that younger spouse so they're not forced out of their home because the loan amount grows too high. Now, on this next slide, I'm going to get into what I think is probably the biggest objection point with a reverse mortgage. It's the mortgage insurance. Many times when a senior homeowner looks at the reverse mortgage product, they get a little bit shocked by how much a mortgage insurance is on a HECM reverse mortgage. Again, the FHA home equity conversion mortgage, the HECM reverse mortgage. First thing I want to tell you is the mortgage insurance cost is actually quite similar to the mortgage insurance cost on a traditional FHA forward mortgage. Now, that's a program that's been well accepted for something like 70, 80 years. And yes, FHA mortgage insurance on a forward mortgage is deemed to be expensive. In fact, it's typically upfront premium of 1.75% of your base loan amount and then 0.55% annually. That's expensive, but you can finance the upfront premium into your loan amount, and the 0.55 actually is competitive with private mortgage insurance. It's really not that bad. Reverse mortgage is similar, but it's slightly different, and here's how. The initial premium, it's actually called initial mortgage insurance premium, IMIP, not upfront MIP. So it's initial MIP. It's actually 2% of the lending limit or your property value, whichever is less. Now, the lending limit currently is $1,089,000. So your 2% up front or initial mortgage insurance premium is going to be 2% of that limit, unless your home is appraised for a lesser amount. For example, if your home is appraised at $800,000, then that initial mortgage insurance premium is going to be $16,000. Most homeowners are like, get a little bit shocked by that number. And then, of course, your annual mortgage insurance, 0.50, again, similar to traditional FHA mortgage insurance forward mortgage. Now, this mortgage insurance, though, is part of your mandatory obligations along with other closing costs to arrive at your remaining principal limit. So this upfront or this initial mortgage insurance premium is essentially paid for out of your principal limit, again, also known as gross loan amount, to arrive at your remaining principal limit. That remaining principal limit is the amount of funds you have access to. So keep that in mind. Now, you're going to say, why in the world is this mortgage insurance so expensive? I mean, 2% is a lot of money, $16,000, $18,000. If your home is worth at least $1 million, $2 million, $1 million, you're talking about $21,000 in mortgage insurance. A homeowner is going to look at that and go, why in the world am I going to pay so much in mortgage insurance? The reason is the primary benefit is it's a non-recourse loan. That is huge. What do I mean by non-recourse loan? What that means is you or your heirs, if they inherit your property, will be protected from owing anything more than what the property is worth. In other words, if the home value has gone up over the years, but the loan balance has grown substantially, and then maybe there's a dip in the real estate market to where your home values drop below what you owe, and that can happen either while you're still alive as the senior homeowner, or maybe you've passed and your heirs have acquired the property, and they're in that situation where the home is underwater on the mortgage, as we call it. You are not, and your heirs are not responsible for that deficiency balance. That is a huge, huge benefit. It protects both you as the senior homeowner and your heirs when you pass away. You will never be required to pay that deficiency balance. That's the reason FHA mortgage insurance, or actually I should say HECM FHA mortgage insurance, is at the level of cost that it is. It is used as a protection for you and your family, so you never have to pay more than the home is worth at the time you're paying off that reverse mortgage. So don't forget that. That is a huge benefit. I cannot understate enough how important that is, again, to protect you as the homeowner as well as your heirs when they take over that property. Now, the next slide I want to get into is closing costs, because this gets a little bit confusing and a little bit misunderstood too. As I mentioned, of course, closing costs, beyond the mortgage insurance, closing costs are going to be very similar as to any other forward mortgage. You're going to have your typical costs, your appraisal, your credit report, your escrow, title fees, all the traditional things that you're going to pay on a traditional forward mortgage. You're going to have the same kind of closing costs on reverse mortgage. There's nothing unusual or extraordinary about the closing costs on a reverse mortgage versus a traditional mortgage. And again, yes, we just covered the mortgage insurance, a little bit higher than FHA traditional first mortgage or forward mortgage, but not substantially higher. And again, that benefit is so huge, I think it's well worth it and should not be dismissed simply because of the cost. Where you do want to watch out, though, when it comes to getting a reverse mortgage, is the origination fee. With some originators, whether you're getting a fixed rate, a HECM reverse mortgage, or an adjustable, you can see an origination fee of as much as $6,000. Now that's on top of the mortgage insurance. That's on top of the other traditional mortgage closing costs. Now at MortgageWorks, we don't charge that origination fee of $6,000. And that's on an adjustable rate loan, because it's that type of loan where we have control on what the origination fee is going to be to the borrower. And our policy is we've never charged that fee at all. We get paid by the lender, not by the borrower. So if you come to MortgageWorks for one of these, we're not going to charge you a $6,000, $3,000, $2,000 origination fee on an adjustable reverse mortgage. Now, if you choose the fixed rate option, maybe we determine in your circumstance it's the best option despite the shortcomings I talked about earlier. You are going to see an origination fee. It can be as much as $6,000, but that's because it's going to get charged by the lender funding the loan, not by us. So just keep that in mind. That is the only aspect of an origination fee you might see on a HECM reverse mortgage, is if you take the fixed rate option. So again, understand that these closing costs, including the mortgage insurance, the origination fee, and the existing customary closing costs, all are going to be deducted from your principal limit to arrive at your remaining principal limit. And again, I covered those earlier: existing mortgage liens, property-related expenses such as property taxes and homeowners insurance and mortgage insurance and other costs. So again, something to understand about reverse mortgages and closing costs, not out of the ordinary, not highly unusual. Yes, the mortgage insurance is not inexpensive, but well worth it. And then watch out for that origination fee. If you're looking at a reverse mortgage, talk to us. We'd be happy to give you the numbers, and we can show you how you can get that loan, particularly the adjustable, without an origination fee. We can save you money by doing that. So then I want to go ahead and kind of finish up here with on the subject of reverse mortgages. Think about, try to think outside the box. Well, what do I mean by that? I just finished covering about the FHA HECM reverse mortgage. That is the core product in the industry, in the country, nationally. But there are other additional options that we can provide you. HomeSafe, that is a proprietary reverse mortgage product. It's a non-FHA product, and it has some interesting benefits. You only have to be 55 or older. You don't have to be 62 or older. There's no mortgage insurance, and you can get loan amounts up to $4 million. That's important. There's some, higher priced homes out there with homeowners who are, approaching senior age, but not quite there, not that magical 62, but they're 55 plus. This can be a great option for someone owning a more expensive home. The reverse mortgage, the HECM product, doesn't quite meet their needs in terms of loan amount, access, and so forth. A HomeSafe product is a great alternative that we can show you for that higher priced homes and for those who where the HECM reverse mortgage doesn't meet your needs. Also, a unique product we have, a HomeSafe Second. That's a proprietary second mortgage, and it's a reverse mortgage-like product. Why? Because it gives you that payment flexibility. You don't have to make payments unless you want to. And if you do want to, you can make payments in amounts that you choose, interest only, pick and pay, different amounts from time to time, monthly, quarterly, a couple of times a year. Again, minimum age is lower. You only have to be 55. No mortgage insurance. It is a fixed rate loan product, so you get all your money at once. It's not a line of credit. There are some requirements in terms of credit score, minimum of 600. You do have to go through a financial assessment as well. There is a debt to income approach, debt to income ratio approach that is required to be met. But if you miss that, a secondary way to get approved is residual income. So again, in addition to the HECM reverse mortgage core product, we can offer you these proprietary products, which of course will hopefully help a wider range of senior homeowners who need ways to access their access their equity for cash and use it for a multitude of purposes. So I hope this helps you understand a little bit more clearly how a reverse mortgage works. We would love the opportunity to help you understand it in more detail, have a conversation. I can put together a proposal for you tailored to your particular situation. Then we can talk about the numbers and then hopefully help you gain that financial independence and reach your retirement goals in the best way possible to enjoy your senior years. So with that, I want to thank you for watching and listening to this week's Mortgage Minute and all about HECM reverse mortgage. Thanks for listening. We'll see you next week. Have a great weekend and talk to you soon. Bye.